Good afternoon. My name is Barry Flagg, founder of Veralytic Research, and I'm here to welcome you to the 6 essential ingredients to life insurance advice brought to you by Lineberg Information Services. Somewhat ironically, this presentation was planned well before we knew there was going to be tax reform, well before Heckerling, but it is fortuitous that we're talking today because at Heckerling, Larry Brody and Ann Mancini and Charlie Ratner presented on what the Heckerling is going on with life insurance after tax reform. I thought they did a great job explaining, in my view, why the estate planning professional is essential, needed more than ever to ensure a positive, or in their absence, a negative impact that life insurance can have on clients' plannings due to, as they discussed, the low interest rate environment that we're in and the margin pressure that puts on life insurance companies, the fact that life insurance companies are increasing cost of insurance charges, both in response to their difficulty in making their margin on the interest rate side, and because some may have seen the report that for the first time in decades, life expectancies are on the decline in the U.S., and in response to tax reform. I thought they did a terrific job outlining the things that are important to understand, starting with clients' objectives and priorities and constraints and circumstances, understanding the vintage, the type, the rates and terms of the in-force or proposed policies, the terms and tax characteristics of ILETs or split dollar arrangements, if applicable. And then they also discussed how to, or the various outcomes that are possible given those circumstances, from maintaining and managing a policy to perhaps replacing or repurposing or maybe selling a policy on a life settlement secondary market, or surrendering or donating a policy to charity. I thought it was a terrific presentation. I highly recommend listening or getting it, and/or I believe LISI is doing a recap of that, even if it's just Marty Shenkman's recap. And as I said to Marty Shenkman last year in an interview for his notes from Heckerling, I am convinced that the estate planning professional is essential to the proper management of life insurance, because while some professionals are involved in some of these outcomes, some professionals are involved in replacing policies, maybe repurposing policies, maybe selling policies, but no one but the estate planning professional is involved in or should be involved or have some role in all of those outcomes that they discussed. So my goal here today is to give you a decision-making framework that helps you go from understanding the client's goals, objectives, priorities, constraints, and circumstances, understanding the situation, to deciding which of these various outcomes are in the client's best interest. After all, life insurance is certainly often integral to planning. It has 4 unique tax preferences that no other asset has, from income tax-free death benefits to tax-deferred growth of cash values to non-taxable withdrawals on a FIFO accounting basis, to non-taxable loans where you can borrow your gain out of the policy, the only asset that allows you to do that. And then the structured properly, the tax-free death benefit repays the loans, effectively duplicating the tax treatment of a qualified plan or perhaps more akin to a Roth IRA. In addition, life insurance has unique risk management characteristics and asset protection qualities. So for all of these reasons, life insurance can be an ideal tool for asset protection, income tax planning, estate tax planning or estate tax financing, funding buy-sell arrangements, and/or supplemental retirement plans. Given all this, I used to wonder why some estate planning professionals seem to resist considering life insurance in their planning. But then I discovered that it is that without the estate planning professional or other fiduciary, life insurance has become the last, largest, most neglected, and for reasons we'll discuss, oftentimes most disappointing asset on the client's balance sheet. I too often hear it's too complicated to understand. But what I hope to do today is show you that it's not really that complicated. It's more obfuscated. And it's obfuscated because few people know what they're actually being charged inside the policy. And even fewer know that there is as much as an 80% swing between good and bad pricing. That means that some people are charged almost twice which other people are charged. And it's not just the estate planning professional or the client that doesn't know this. Too many life insurance producers don't know what's being charged inside the policies. Too few also know what's actually being earned in performance. There's too much reliance, at least in my opinion, too much reliance on hypothetical illustrations that show some projected rate of return that may or may not actually correlate with actual historical performance of invested assets and underlying cash values. So it comes to me as no surprise that if very few people know what they're actually being charged and very few people know what they're actually getting in performance, it's really not a surprise that life insurance has been among the worst performing asset types relative to clients' expectations. But from my experience, this poor performance is not because life insurance is a bad product. We talked about all of the unique and beneficial attributes of life insurance just a few minutes ago. It's not that it's a bad product. It's that from my experience, which I'm going to tell you a little bit about, the life insurance has been managed, for lack of a better term, using the wrong operating system. And I talk about life insurance and life insurance and the fiduciary operating systems as different operating systems in the same way that Apple has an operating system. I carry around an Apple phone, and Microsoft has an operating system. I use a Microsoft Surface computer. And if you try to run an Apple iOS app on a Microsoft Surface computer, nothing good happens. It's not that one operating system is better or worse than the other. It's just that they were designed for different things, designed to do different things. And I started my career in the prudent investor operating system, if you will. I started my career as an analyst in a pension investment advisory department in the early days of ERISA. I also was the youngest CFP in the history of the College of Financial Planning, and the CFP is one of the designations that is a fiduciary designation, imposes a fiduciary standard on its certificates, and has oversight. So I understood from that education as a CFP and my experience as an analyst in this pension investment advisory department, I understood the information that was necessary to prudent, with a capital P, prudent decision making. I also had a front row seat to what ERISA did again, I call it an operating system, as an operating system, and the three market forces that changed the investment business. When I was an analyst in this pension investment advisory service, pension investment advisory business, there were more loaded mutual funds than there were no load funds. There were things called investment contracts that paid commissions of 50% or more on deposits. Investments were oftentimes sold off of hypothetical projections, in much the way that life insurance is today. But ERISA changed all that. And ERISA only applied to qualified plan assets. But because qualified plan assets was a large enough chunk of the entire investment business, that it ended up transforming the entire investment business. Once this new operating system was the law of the land, third-party administrators came into being to help plan sponsors and participants understand what they had in their accounts, because it was required. Third-party publishers of research, like Morningstar, began publishing research about the pricing and performance of not just the fund that may be in the account, but of all funds, so that participants and plan sponsors could perform their duties and understand the costs and understand performance and how cost and performance are related to the universe of peer group alternatives and make more prudent decisions. But as is almost with anything, human nature doesn't change because they want to, they change because they have to. And so while ERISA was enacted in 1974, it wasn't until the late 80s, early 90s that regulators and litigation began to really enforce the rules of this new operating system, which is when it really took hold. Along the way, I went from this pension investment advisory analyst, actually while I was still in school, graduated and sought to diversify my experience and broaden my resume, and went to go work for a life insurance agency. And some of you know that I'm only half joking when I say I pulled my hair out trying to do what was easy as a 20-something-year-old using Morningstar on mutual funds. It was literally impossible to do the same type of analysis on life insurance. Like you, I was frustrated by the use of by the comparison of hypothetical illustrations as supposed due diligence. I knew what was necessary for prudent decision making and struggled to get the cost information and the actual historical performance information. But I'm also now seeing the same things that I saw in the early to mid days of ERISA, that this new operating system, the Uniform Prudent Investor Act, is the new operating system. Just like ERISA applied to life insurance trusts, applied to qualified plan trusts, the Uniform Prudent Investor Act only applies to life insurance trusts. But because there is a lot of life insurance held in irrevocable life insurance trusts, it's my belief, and I'm already seeing it, that these new operating systems are going to, or this new operating system is going to have a similar impact on changing the most of the life insurance business over the next decade or two or three, bringing with it the promise of greater transparency, lower costs, and better performance, because we have the same three market forces doing the same things. Most institutional fiduciaries, most large banks or trust companies, and in fact, many large law firms have hired third-party administrators to get the information from the insurance companies, put it all into an admin system so the trustee or the fiduciary or the organization can know who has what, how much exposure do we have to a particular carrier that may be downgraded, produce reports for grantors and beneficiaries about what's in the account, what's the death benefit, what's the cash value, what are the premiums, that kind of thing. Just like third-party administrators did for qualified plans in the 70s and 80s. And we started publishing research about the pricing and performance research, pricing and performance research for life insurance products in the late 90s and early 2000s. Probably 3-4 years ago, we started to see litigation and some regulation, more litigation in the area of enforcing these new rules. That there are these things that people should or have to be doing, and if you're not, then some of those people have been targets for litigation, which we'll talk a little bit about that. So from this combined experience, this experience of having started in the fiduciary world first with the prudent investor operating system, and then spent time in the life insurance industry and learned to understand the life insurance industry operating system, let me tell you a little bit about what I've learned. I learned that all assets, including life insurance, have expenses and they have some performance expectation. Those things are not necessarily apparent or made apparent or disclosed in most illustrations. But inside that illustration, there are expenses and there is a performance expectation. I also know from my fiduciary days that prudent investor principles require an understanding of both, and that prudent investor principles don't guarantee a result, but that if you understand the things that prudent investor principles prescribe, then you will have a better chance of client expectations being met. So I would suggest a new performance formula. I would suggest throwing out these illustrations, these hypothetical illustrations, and instead understanding if you want to know if a policy is truly competitively priced or not, if you want to know if it's likely to outperform its peer group, if you want to know that whether or not it's reasonable, whether or not a given product is reasonable that it's expected to meet client expectations, then there are three things you have to know. You've got to know what the insurance company is charging for cost of insurance charges. It's the largest expense in any life insurance policy. It's 85% of total expenses. And this is where most of that 80% variance between good and bad pricing comes. It is also important, not as important, but important to understand the expenses charged for design, marketing, sales, distribution, underwriting, administration. And it is also important to understand what the insurance company is actually presuming or using in their calculation of hypothetical values. What are they actually? What are they? On what rate are they setting expectations? So there are probably two things that if you take nothing else away, this is one of them. When you're presented with a illustration that shows hypothetical values, make sure you ask for what are commonly referred to as detailed expense pages, where they delineate. The detailed expense pages show the math that go from premiums minus premium loads, minus fixed administration expenses, minus cost of insurance charges, plus some amount of interest, equals cash value. It's the math behind premiums to cash values, commonly available in the detailed expense pages. And this formula, COIs plus E minus I, is my easy way, or at least the way that I find easy to remember, that this is much more important than whatever hypothetical premium some proposal may say or some in-force illustration may suggest. So this new performance formula is also consistent with prudent investor statutes, which we'll talk a little bit about. It's consistent with guidance, relatively new guidance from the chief regulatory body of the financial services industry, whose mission is to protect the consumer. It is also consistent with the chief regulatory body for institutional fiduciaries, and certainly good guidance and certainly thus good guidance for all fiduciaries. It's also guidance. It's also consistent with guidance from the chief actuarial body of the life insurance industry, and an organization that we'll talk a little bit about more than a little bit about at the end, that is responsible for new best practices that we'll talk about halfway through. And I want to contrast that with, on the other hand, the chief regulatory body for the life insurance industry, or at least the body that sets suggested language that each of the states adopt, or suggested regulation that each of the states can adopt as is or modify, the National Association of Insurance Commissioners. I want to start with their attempt at providing consumers with the information needed to make a prudent decision about life insurance. In 1993, they first issued the illustration model regulation, in which their mission was, or the goals were, to ensure that illustrations do not mislead purchasers of insurance, and to make illustrations more understandable. And I've given this training dozens of times, and when I'm in front of a live audience, I ask for a show of hands for how many think that the illustration model regulation accomplished its goal to ensure that illustrations do not mislead and to make them more understandable. And I don't get a single hand raised, as many of you or all of you probably imagine. In fact, even the National Association of Insurance Commissioners, after 22 years of trying to make illustrations more understandable and less misleading, after 22 years, they issued an update, another update in 2015 to address a lack of uniform practice that resulted in illustrations that used an apparently identical crediting approach. So when we look at it, it looks like I'll pick a rate of return. One illustration shows 5%, another illustration shows 5%. It appears to be an identical crediting rate, and yet the products were using different rates of return. So instead of the guidance, if we can call it that, from the life insurance industry or the rules of the life insurance industry operating system, let's look at guidance for fiduciaries that's been tested and proven over 200 some years of case law, debate, litigation, and that's the Uniform Prudent Investor Act. And the Uniform Prudent Investor Act says that fiduciaries have a duty to exercise reasonable care, skill, and caution. And so what constitutes, so where can we look for guidance about what constitutes reasonable care, skill, and caution when it comes to life insurance? Well, as I alluded to earlier, the chief regulatory body of the financial services industry issued Rule 2210, in which it said it is inappropriate to compare a life insurance policy to another based on hypothetical performance. It is inappropriate to compare hypothetical illustrations because doing so, if you don't consider the things that prudent investor rules say are important, like expenses, then the omission of that information makes hypothetical comparisons misleading. Some say, well, the FINRA only has jurisdiction over variable products. And some practitioners say, I don't believe in variable. I only use universal life or whole life. Well, the chief actuarial body of the life insurance industry commissioned a study actually some years ago, which has largely been ignored for whatever reason, saying that comparing hypothetical illustrations one to another for the purposes of determining which policy performs better is not just inappropriate, it is fundamentally inappropriate. And most recently, the OCC updated their handbook for unique and hard to value assets to add a chapter for life insurance. And in that chapter, they comment that these policy illustrations are subject to a high degree of fluctuation and therefore not very reliable for determining which product is better. So at the risk of stating the obvious, the policy reviews or policy audits that are pretty widely marketed as due diligence tools or decision support tools by the life insurance industry, but which three separate industry authorities consider misleading, fundamentally inappropriate, and unreliable, that hardly supports a fiduciary's duty to exercise reasonable care, skill, and caution. And in fact, as a fiduciary, I'd be concerned that having illustration comparisons in my file could put me in harm's way by exposing me to breach of my duty to exercise reasonable care, skill, and caution. And in fact, in my work as sub-advisor to a couple thousand life insurance trusts, I urge them to keep illustration comparisons absolutely positively out of their files. So instead, what I encourage them to put in their files is the things that the Prudent Investor Act guides us to have or requires us to have, which includes costs. We need to examine costs, not the hypothetical premium, but what is actually being charged inside the policy. We also have a duty to have a reasonable expectation as to the rate of return relative to acceptable risk that we're expecting, the risk of being redundant. And that's what the Prudent Investor Act considers reasonable care, or those are at least elements of what the Prudent Investor Act considers reasonable care, skill, and caution. This disconnect between the life insurance industry operating system and the prudent investor industry operating system is a consistent theme in my experience of clients who have been disappointed in their life insurance, and is increasingly a theme in complaints and arbitration and litigation. In fact, the Cochrane case, I think, is a poster child example of the differences between the life insurance industry operating system and the prudent investor industry operating system. I wrote a two-part, or I co-authored a two-part article for the Lineberg Information Services newsletter shortly after the case was adjudicated. And I don't know if it was Steve or one of my co-authors, one of my attorney co-authors, who described the case as a must-read case. It was a case that involved a client who had $4 million of universal life and whole life, which by regulation, as a practical matter, invested assets underlying cash values have to be invested in high-grade bonds and government-backed mortgages. In other words, a conservative risk profile. Some years later, as the stock market was going up in the 1990s, the agent proposed an exchange of the $4 million of whole life and universal life to $8 million of variable life, quote unquote, with no additional cost. Of course, that was not really an accurate statement, because it wasn't that there wasn't any additional cost. It was that the universal life and whole life illustrations were using a low rate of return, and the variable life illustration was using a high rate of return. And those assumed earnings, which I'll come back to, those assumed earnings were supposedly going to pay the higher costs of the variable life policy. But when the go-go stock market of the 1990s, from the dot-com boom, crashed into the dot-bomb bust, the cash values of the variable policy lost $37,000, which was actually exactly what should have happened. The policy was allocated to the 100% equities, including an allocation to emerging markets and small caps, and the fact that the cash values, which were about $500,000, the fact that those cash values declined by only 7% with that kind of asset allocation means that the cash values did exactly what you would expect from an aggressive asset allocation. There's no record, nothing in the record to suggest that they had any conversation about going from a conservative asset allocation to a aggressive asset allocation, which is another difference between the life insurance industry operating system and the prudent investor industry operating system. But even though the cash values behaved exactly as they should have been expected to behave, the agent came back to the grantor saying, we're losing money. This thing's too risky. This is your life insurance. We got to get out of this. And so he suggested another exchange to a guaranteed universal life policy, which was the flavor of the day product in the 2000s. And the trustee, to their credit, had a third party with no economic stake in the outcome review the transaction. And they said that so long as this was consistent with the grantor's intent, then the third party kind of blessed the transaction. And they proceeded with the exchange. And as Murphy of fame, Murphy's Law would have it, 6 months later, Mr. Cochrane dies, and the beneficiaries sue for the difference between the $2 million they received from that guaranteed universal life policy versus the $8 million that they thought they were entitled to in the policy they had just 6 months earlier. I wrote an article for Trust and Estates magazine. In addition to the articles I've written for Steve, I wrote an article for Trust and Estates magazine that takes the two articles I wrote for LISI and puts them together. It's a piece I'm very proud of, but I think it is a poster child of for understanding the differences between the life insurance industry operating system and how to protect you and your clients under the prudent investor industry operating system. I don't have time to go into all these other cases. Each of them are kind of interesting. The one that is most, I think, instructive is a case, interesting and instructive, is a case against Goldman Sachs by a convicted felon who, and it's partly interesting because he had an axe to grind. His advisor testified against him and was instrumental in him going to prison. So he clearly had an axe to grind. But that doesn't mean that some of the facts are not instructional. The facts included Mr. Naccio hiring this subsidiary of Goldman Sachs called ACO to advise him. So they actually weren't trustees of a life insurance trust, but they were hired as advisors, as fiduciary advisors to advise him on the purchase of $95 million worth of life insurance. The advisor at the time ran a lot of illustrations, compared a lot of illustrations, and came to a conclusion to recommend a particular product. Some years later, after Mr. Naccio is now in jail and he's not quite very happy with this financial advisor nor the subsidiary of Goldman Sachs, he hires another financial advisor who runs a lot more illustrations and comes to the conclusion that the policy he purchased was the wrong policy and that he should have had a different policy and that this illustration looks better than that this illustration comparison looks better than that illustration comparison. I know both of the experts in the case, and both insurance advisors, if you look at what they did in the context of the life insurance industry operating system, they did a lot. They ran a lot of illustrations. They compared a lot of illustrations. They compared a lot of hypothetical values. One could argue that they tried to do, they did their best for that operating system. But because neither side could tie their recommendation to prudent investor principles, because neither side examined the internal cost, because neither side had any documentation as to the risk profile, the asset allocation that corresponds to the risk profile, the rate of return that would correspond to that asset allocation. It became more of a, who's a more compelling attorney or who feels sorry for the wife whose husband is now in prison. It ended up being a crapshoot. And frankly, in reading the case, it could have gone either way in my reading. But the moral of the story is, if you tie your due diligence to prudent investor principles, then you tie it to the law, and then it doesn't risk going either way. So this change in prudent investor principles, this change in the life insurance industry, in going from a life insurance industry operating system to the introduction of the Uniform Prudent Investor Act and the fiduciary principles being applied to life insurance, seeing that disconnect between those two operating systems, the Financial Planning Association formed in 2011 a task force to try to provide support for their members on the prudent selection and proper management of life insurance in the same way that they provided support for their members on the prudent selection and proper management of say, mutual funds. This task force was culminated in 17 individuals coming together at West Point in 2003. each of which was a representative of the most of the professions who have clients who own life insurance. There were representatives from the trust and estates law firm, a representative from the largest third-party administrator of trust-owned life insurance, a representative from the largest association of certified financial planners, which as I mentioned before, is a fiduciary-oriented or fiduciary organization for financial planning, a leading financial planning institute, and several of the largest independent distributors. And the goal was to come up with a framework or to apply the widely accepted universal decision-making framework already used in the investment business to the life insurance business. And that six-step process, in some organizations, it's a five-step process, but the components are generally the same. It is six steps of what most of you already know, or at least have some familiarity with, for every other asset on clients' balance sheets, but now applying it to life insurance. For instance, time doesn't permit me to go in depth through, there are 17 dimensions of the six steps. Time doesn't permit me to go through all 17 dimensions, but I'm going to hit on a high point for each of the six steps. So one of the first things to do is, just like in the mid-1980s when I was in the pension investment advisory business, or an analyst in the pension investment advisory business, there are conflicts everywhere in the life insurance business. There were conflicts back then. I mentioned commissions on certain high commissions on certain types of products, loads on mutual funds. Those are conflicts, and there were more commissioned investment contracts or loaded mutual funds than there were no load funds in those days. Same holds true today. There are conflicts everywhere in the life insurance industry. It's not that it's bad. It's just they need to be reconciled. I know some say that no load or low load life insurance products eliminate the conflicts, but I don't think that's the case. Not that compensation is a conflict that needs to be reconciled, but there are only a small handful, maybe not even a handful, of life insurance companies that manufacture no load or low load products. So limiting the universe to those few companies when there is this 80% swing between good and bad pricing, and most of that swing comes in cost of insurance charges, and those cost of insurance charges vary for every age, gender, risk class, smoker status, face amount. So there are as many as 10,000 different pricing combinations and permutations for every single product, and no insurance company is good at all of them. And so if you limit your universe because you have a compensation model that is fee only, if you limit your universe to only those products, that is a conflict with clients' best interests. In the same way, no mutual fund company has the best funds for every client. No life insurance company, or no handful of life insurance companies, always have the right product for every single client in a client situation. So step one is defining the roles of those on the team and understanding the conflicts of interest. And as Larry and Marianne and Charlie tell us in their Heckerling presentation, it is important to establish goals and objectives early on. In my experience, in the answer from the life insurance industry to almost every problem is whatever is the latest and greatest product. In the 1980s, the solution seemed to be universal life for everything. In the 1990s, it seemed to be variable life for everything. This is just like the Cochrane case. In the 2000s, it seemed like guaranteed universal life is the answer for everything. And nowadays, it seems like indexed universal life is the answer for everything. But the product type is not an answer in and of itself. So it is important to analyze the client's situation, client's circumstances, their goals and objectives in a way that more naturally leads to prudent product selection or retention, and that starts with, and there's a neat little tool or neat little acronym to remember. So this is the second thing that if you take away nothing else, you take away the cost of insurance charges plus expenses minus interest, COI plus E minus I formula, you take that away. The other one is this acronym RATE, R-A-T-E. The rate of return that's reasonable to expect from any life insurance product is a function of the risk tolerances of the client, the asset allocation and asset class preferences corresponding to that risk tolerance, the time horizon over which we are expecting to hold this asset, and the expected outcomes, or the rate of return that's reasonable to expect. So that rate that comes from the RATE tool, that rate of return is what determines product type, not whatever the illustration says. For instance, if a client is in a conservative risk profile, well, modern portfolio theory tells us that a conservative risk profile would have a 20-80 asset allocation. And the historical rate of return for benchmarks for the asset classes corresponding to a conservative risk profile would be somewhere between 5 and 6%. So there, the product that would be optimal or most logical to use would be some form of universal life or guaranteed universal life or whole life. Conversely, at the other end of the spectrum, if a client had an aggressive risk profile and was comfortable with the volatility or the fluctuating values and the risk of a premium call associated with an equity portfolio, then variable life would be the most appropriate product type. There's a lot of talk about indexed universal life. Indexed universal life too often shows rates of return in the 7, 8, or 9% rate of range, and some are showing a lower rate of return, but actually calculating hypothetical values on a 7, 8, 9, or higher percent rate of return. The indexed universal life product is required to invest cash values in the insurance company's account of bonds and mortgages. They can only use the interest from those bonds and mortgages to buy the options. If you do the math, which I don't have time to do here, but if you do the math, it is questionable at best to think that invested assets underlying cash values that have a historical rate of return of 5 or 6% could, through the use of options, leverage that up by 200-300 basis points. That's just questionable. I've not seen anybody demonstrate to me that is mathematically possible. So once we have defined roles and understand conflicts, we've analyzed the client situation in a way that more naturally leads to prudent product selection, and then we've used the rate tool to identify the product types most aligned with client selection. It's time to search for best available rates and terms. But it's important to understand that the life insurance industry has constraints, again, not unlike the investment business of 3 or 4 decades ago, when we didn't have the open architecture platforms that we have today, where most every mutual fund or other investment option is available on an institution or an advisor's platform, where it used to be that a financial advisor would sell American funds because they didn't have access to anything but American funds. Those same type constraints exist today, and those constraints don't mean they're not good or bad. It just means that it's important to understand that if you're as a fiduciary, if you're seeking to serve the client's best interest, and you only have a limited universe because you have either constraints of your the advisor has constraints in their compensation model or their distribution channel, or they have a preference for proprietary products, then it's just important to understand that going in so that you can reconcile, again, that constraint just like you reconcile conflicts early on. Searching for best available rates and terms. Step 5, once we get to, okay, now we actually need to find, do we have the right policy in the first place? Are we better off with a different product? And when I say better off, I don't mean that the illustration looks better. I mean, are costs higher now, and could they be lowered? Is the performance poor, and the actual performance of invested assets underlying cash values can be improved? So searching for that product involves at least certainly considering the financial strength and claims paying ability of the company, absolutely considering the cost competitiveness of the charges inside the policy, understanding the stability of pricing representations. While I can make an investment in a mutual fund, and if I want to change my mind, I can change it pretty quickly. If I make a quote unquote investment into life insurance as an asset, and I have a change of health, I can't get out of that at all. So if a carrier has a track record of maintaining their prices, that would be preferable to one that has a track record of increasing costs, which some do right now. Certainly another consideration is cash value liquidity. That's not to say that cash value is always important, but if you're going to give up liquidity on something, then you should get something for it. Just like in a hedge fund, if you give up liquidity, you want a higher rate of return. So if I'm going to give up liquidity in my life insurance policy, I would like to get maybe lower costs. And certainly a consideration, the one that is most inexplicable to me, is how many people rely on the projected rate of return on the illustration, and neglect to ask what's the actual historical performance underlying uninvested assets underlying cash values. Is this carrier got a good track record or a bad track record? It's a question that is asked about almost every other asset on clients' balance sheets, but is too often not asked about life insurance. The biggest unknown, though, is in costs. The biggest variance is in costs. Adam Smith would say that's because the invisible hand of the consumer can't choose between good and bad pricing because the prices aren't, or the internal costs are not widely known. And that's why I think that's the number one thing to do is to ask for detailed expense pages. If you're presented with an illustration and it doesn't have detailed expense pages, you gotta one, maybe find somebody who gets them to you proactively, or two, ask for them. It is the fastest, easiest, nearly free way to understand what is actually being charged and whether it's reasonable or not. And if you want to understand how those costs relate to the universe of peer group alternatives, then we can get that to you too. At the end, I'll offer a complimentary report to everybody on the webinar. But you can find out not just what is being charged, but because we have a database of the largest database of cost of insurance charges and admin fees and premium loads, we can calculate the average cost. That's how we also know that there is an 80% variance between good and bad pricing, which coincidentally is corroborated by studies from Tillinghast Towers Parent and a third-party administrator of trust-owned life insurance. But once we have the data where we can calculate the average or the mean, and we can calculate the standard deviation, then we know for every given situation what's the worst rates and terms in the marketplace, at least within a couple standard deviations within a reasonable expectation, and what's the lowest, what's the best available rates and terms in the entire marketplace. And in a matter of minutes, less time than it took me to explain this. Knowing what's the best price in the marketplace and how the cost inside a client's policy relate to that is in my opinion, albeit have a commercial interest in this answer, is a much more prudent, with a capital P, way of exercising reasonable care, skill, and caution in the performance of duties to examine costs and set reasonable performance expectations. Lastly, another of the big differences between the life insurance industry operating system and the prudent investor industry operating system is that I jokingly say, kind of in this operating system analogy, that the life insurance industry operating system has no monitoring module. So when you're when you're trying to decide whether on the outcomes that we talked about at the beginning, you're trying to decide whether or not you want to maintain or manage a policy, or you want to replace or repurpose or sell a policy, or surrender the policy, or donate it to charity. Forget the illustrations showing hypothetical future performance, and instead look to the advisor for whatever they produce in the way of periodic reporting that shows costs, measures costs ideally, shows actual historical performance, measures it against peer group alternatives. That is far more consistent with the fiduciary industry operating system than what the life insurance industry has output thus far. And as I said in an interview with Marty Shenkman last year in his notes for Heckerling, and as I said at the beginning of my remarks here, I am absolutely convinced that the estate planning professional is essential to the proper management of what otherwise has been, and but for their involvement, likely will continue to be the last, largest, most neglected, and most disappointing asset on clients' balance sheets. While some of the team members have roles in some of those outcomes that we mentioned, only the estate planning professional has some role in every potential outcome. I hope today's webinar gives you a framework for decision making that helps you go from kind of understanding the client situation at one end and all the various outcomes at the other end, to be able to put those two together into the outcomes that serve the client's best interest. If you find this topic interesting, I did write a paper or an article on this topic for Lineberg Information Services. It's their LISI newsletter 2547. You'll also get a copy of it, or you can download a copy of it here as part of this webinar. And it goes into more depth into each of the the 6 branches of the decision tree, and includes flowcharts, flowcharts and diagrams for making decisions for if this, then that, if this, then that. Following this new guidance from the best practices and from FINRA and the Society of Actuaries, and avoiding what is now considered misleading, inappropriate, and unreliable, certainly gives us, I certainly hope, at least it has for me, increases the likelihood that client expectations are met. And if anybody would like a copy of the best practices, I'm happy to send them to you. I'm also happy to send a copy of that Trust and Estates article I mentioned, or the Goldman's, what advisors can learn from a convicted felon's lawsuit against Goldman Sachs article. There are also, I'll also disclose this as a marketing piece, but we have a piece with the 3 questions to ask about every policy review to determine whether or not it's more of a sales tool for a particular product or a fiduciary tool that's designed to support the things that fiduciaries do. And then, as I mentioned earlier, happy to provide anybody on the call with a complimentary Veralytic report on our nickel. Every report includes an executive summary. It includes a graphic analysis that you saw a piece of earlier. And if you like what you've seen and heard and want to know more about the prudent, with a capital P, selection or retention and proper management of life insurance as an asset according to fiduciary principles, I post all of my writings and speaking engagements to LinkedIn and Twitter, so feel free to follow me there. If you have any questions, now would be a good time to type them into the chat box, or you're also welcome to email me if you'd rather do it later, or if you're listening to the recording. So let's see, do we have any questions? So here's one for how do I get the cost pages that I mentioned? Again, they're commonly referred to as detailed expense pages, but every carrier has kind of their own name for them. So you would ask the life insurance professional or the agent that you want the pages that show the year-by-year costs, specifically for premium loads, admin fees, and cost of insurance charges. They are available for almost every product. There are a couple of carriers that that are no longer actively selling life insurance, and their systems were never designed to provide that information for their in-force policies, but that is in the distinct minority. They are available by regulation for every variable product, almost every universal life product. For whole life products, we can get it to you, or you can ask the insurance company to have an actuary provide it to you. They do have to calculate it by hand, but if it's a big enough matter, then they typically do that. So let's see, any other questions? With all the data that we have, can you tell us what carriers offer the best products? So I kind of alluded to this earlier. Just like no mutual fund company has the best mutual fund for every client in every situation. Same thing, there are 10,000 different pricing combinations and permutations for every policy. In addition to which, life insurance products operate more like closed-end mutual funds than open-end mutual funds. So an insurance company designs a product, they share the risk of claim payment with a reinsurance company, so they negotiate what's called a reinsurance treaty for a specific amount of coverage. And once that amount of coverage is sold, they close that product down, and they generally open up a new product that has different prices. So there are at least 10,000 pricing combinations and permutations for every single product. No one's good at all of them. No one's bad at all of them. It is no more involved than every other asset on the client's balance sheet, but it is as involved as every other asset on the client's balance sheet. You got to look at what's being charged inside. You got to look at the performance and make sure that the costs are competitive and the performance is reasonable relative to risk that's acceptable to the client. Let's see. How do I get a Veralytic report? For the complimentary report, simply email me. For our subscribers, they go to the website, they sign up on the website, everything's done through the website, but for the complimentary report here, just email me. My email address is on the screen. Just email me and I can tell you what we need. Generally speaking, for universal life, we need a complete illustration, including all pages and all footnotes, and including those detailed expense pages I mentioned. And for a whole life illustration, we need, again, the complete illustration year by year, no summary years, complete illustration year by year, to include disclosure of the dividend interest crediting rate that the carrier used to calculate their hypothetical policy values. So I don't see, let's see. I see a couple other questions, one of which was similar. James, I'll email you a reply because it's kind of similar, but it's a little specific. Someone asked, is your report on cost available from your firm? The cost pages come from the insurance company. The measurement of those costs comes from us. Yes, charged by the insurance company. Yes, the costs, the disclosure of costs has to come from the life insurance company. The measurement of costs against what we have in our database comes from us. So with that, I don't see any more questions. So I'd like to certainly thank LISI for the opportunity to bring you this webinar, and certainly hope this helps you help others to make a positive difference. With that, hope you all have a great afternoon and a great weekend.